Hi, Robert and Lisa. I'm glad to meet with you today in person. There was a lot of events going through your financial plan and a lot of material to cover. So I would like to sit down with you right now and provide you with some input and recommendations on some of the main areas of concern that I came across looking through your documents. And then I also would like to explain to you in detail how you can achieve the retirement goal that you have in mind. Well, first of all, let's look a little bit at your insurance. Based on my calculations, both of your homes, the primary and the residence, are currently underinsured, and it's my obligation to inform you that it is so. So my recommendation to you is to make these changes as soon as possible. Also, in effect of insurance, Lisa, you don't have any life insurance. This is actually considered a financial weakness, and it raises great concern. So I would suggest that you at least purchase some life insurance that covers your current liability and any expected funeral expenses. Robert, your life insurance currently has your sons as beneficiaries and does not make any provision for Lisa. I would at least suggest to consider your beneficiaries in that life insurance. My second concern for the overlooking your financials was your 2017 taxes. You have a lot of events occurring in 2017. The sale of Lisa C Corporation, sale of the primary residence, as well as your vacation home. These events can create taxable tax liabilities, and you want to be prepared for this. So therefore, I would suggest, first of all, that you do wait selling the primary residence until June 1st, 2017, so we can eliminate taxable gain. The reasons for I explain exactly in my financial plan in more detail, but as a summary, let's hold off with the sale on this until June 1st, 2017. I would also consider selling the vacation home rather than gifting it, because the sale of the vacation home actually creates a tax-deductible loss and will help offset some of the gains that we're going to have from Lisa's sale of the C Corporation. All these events have a lot going on, and therefore I would highly recommend for the both of you to go seek a tax professional to make sure you have a better understanding on how these events will affect your 2017 taxes. This will give you the provisions to make, this will allow you to make provisions so you have funds available in case there are any tax liabilities and there's no surprises when you go have your taxes prepared. My third concern was in regards of estate planning or the lack thereof. I don't feel that the simple wills that you have in place are sufficient and in the best interest for the both of you. Again, I would suggest for the both of you to meet with an estate planning attorney. I would suggest setting up a revocable living trust. I feel that this would be the best option that could create provisions in place for Lisa having some income in case Robert passes, but also ensuring that any assets after Lisa passes will go on to Robert's sons and spread equally. A revocable living trust will give you actually the opportunity to make specific and detailed provisions for that. So again, meet with an estate planning attorney to have these documents set in place that will greatly help you for your estate planning. However, your primary question was to me to determine if it's feasible for you to retire within a few months. You have the expectation of $15,000 per month in income without considering any Social Security and with no reduction after the death of the first one. So that's a little challenge right here. However, I think you can achieve this goal. My first recommendations to you are that you sell the primary residence after June 1st. You also sell your vacation home and utilize the tax deductible loss to offset any other gain from Lisa's corporation. Then I would suggest to invest these proceeds from the sales. I also recommend to keep Lisa's investment portfolio invested with some of the recommendations that I gave within the plan. By doing so, all your assets would actually total $3,046,003, which has you short of $1,050,965 of the required capital that you would need to fund the retirement goal that you have in mind. The total capital that will be required to fund that retirement goal would actually be $4,097,008. Detailed explanations on those calculations, again, are provided within the plan. However, even though we're short $1,050,000, I would suggest to look at a 10-year plan first. The monthly income created from the installment sale is about $10,134 for the first 10 years. By selecting the joint and survivor pension benefit plan from Robert's pension, you have additional income of $5,000 for over a 20-year period, considering Robert will not pass within these 10 years. However, even in the event if Robert passes, we could use monthly income from the IRA and Roth to substitute for the 50% reduction. Robert's SPDA adds another monthly income of $1,670 over Robert's lifespan, and this would total your income, monthly income for the next 10 years to about $16,804, which has a little bit of excess of income of $1,800. I will revisit this part again in a couple minutes. I want to just point out to you that we actually, for the 10-year plan, we're in a good position. We actually have a little bit overage for it. We know that after 10 years, given Robert's still alive, the monthly income will be reduced, first of all, for the $10,134 from the installment sale, leaving you with $6,670 at that time. However, at this time, Robert can start taking IRA and Roth distribution, which will combine roughly at $2,196, based right now on a current calculation of annuitizing this for a 30-year period. We would have to calculate a little bit more closer to that amount when we get there. This will be totaling the monthly income at that point at $8,866 after the installment sale comes to an end. So here's my suggestion how to create income to make up for that amount. First of all, I suggest for the first 10 years, we have an overage of $1,804. If you invest that for 10 years, for example, in the S&P 500 index funds, based on an assumption of 10% return, this would create available funds in 10 years of roughly $369,552. If you also invest the proceeds from the sale of both homes, the $543,600, again, based on a conservative 5% return, we would have additional $895,314 available in funds within those 10 years. And if we consider Lisa's current investment portfolio, without making any changes based on the current average return of 7% on her portfolio, we could have funds available of $542,608 within 10 years. With all this said, we will have about $1,807,474 at the time that the installment sale ceases. We can translate that into an additional income roughly of $9,097 monthly. So after the first 10 years, we would actually have monthly income of $17,963, given that Robert doesn't pass. However, even if he passes and we reduce this by the 50%, which will be $2,500 of monthly income less than prior, we would have still $14,563, $500 less than expected, and we're not even considering any life insurance payouts at that point. So that's not even considered in it. Based on the suggestion and calculations I have here, I strongly feel that it's feasible for the both of you to retire within the next few months with an expected income stream of $15,000 a month. However, I highly recommend that you have your financial plan reviewed on a yearly basis, and that we're gonna do some recalculation after the first 10 years and the installment sale income ceases. I hope that you're pleased to find out that your goal of retiring within a few months with the desired income is possible. It was a pleasure to work with you. And of course, please feel free if you have any questions in regards of these suggestions. Thank you very much.